In this video, I'm going to discuss 4 great stocks that you can buy now and hold for a lifetime. And, lifetime is a long time. Things may change, but these companies are really well positioned to deliver great returns for the long term. And in this quick video, I'm going to tell you, not only what those stocks are, but I'm also going to give you a few tips that'll help you maximize your returns on any long-term stock investment. So let's talk about those tips first. In order to maximize your gains, you want to plan on adding money over time. And the reason is, 2 of these stocks in particular are dividend stocks. And dividend stocks are very expensive at the moment. And the reason is interest rates are low. So investors that normally only buy bonds and other safe sort of investments are buying dividend stocks because the treasury notes aren't paying anything. So whenever interest rates go up, we can expect dividend stocks to pull back, especially like the blue chip dividend stocks that people are investing in for the interest that those dividends give out, rather than in being interested in the company itself. So if you're able to buy continuously into a stock, either through your savings or just not putting all your money in right away, this can really maximize your return. So, for example, if you bought a share of a stock at $90 and then it pulled back to $70 a share, and you bought another share at $70, you'd only pay an average of $80 per share for the stock. That's called averaging down. And it's really important for any sort of long-term investment. You never just want to buy all your stock in one sitting and just plan on holding it for 30 years. You want to buy some now, and you want to keep adding to it over time. And that way, you'll never get burned by buying a stock when it's too high. If you're investing steadily in a great company, then you're going to make a massive return. That's pretty much the bottom line with how the stock market works. Invest steadily and continuously, and any sort of drops will just be averaged out. And just the only caveat there is make sure the companies stay relevant. I've included a few tech companies in this list, which are very well positioned to do well over the next 5 years, but who knows what tech will look like in 10 years or so. So, keep an eye, just pay attention to things, and make sure that the companies are still as relevant as they are today. That doesn't mean sell on like an earnings miss or something like that. It means just make sure the companies are, legitimate. And the first 2 stocks I really like, I want to put them on the same slide because they're so similar, are Johnson & Johnson and Procter & Gamble. And Johnson & Johnson is a pharmaceutical company, while Procter & Gamble is a consumer goods company. And both of them really focus on consumer products. Johnson & Johnson makes things like Band-Aid and Tylenol brands, which are, consumer products, but they tend to be focused on the, pharmacy side. And they also make some medical devices too. Where Procter & Gamble focuses on consumer products, one of their big brands is Pampers, diapers. And the reason these stocks are so similar is that they have so many brand names, and they've both been paying a steadily increasing dividend for many years. This is a company, both of these companies, if you invested in 30 years ago and steadily invested in since then, you'd have a fortune today. And things don't look poised to change anytime soon. Make sure you enroll these stocks in a dividend reinvestment program, also known as a DRIP. That will make sure that your dividend is used to buy more shares of the stock rather than just being given to you as a cash payment. The dividend reinvestment program is really going to make these 2 stocks return a big investment, because if you hold a stock like this for 10 years, the extra shares you purchase through your dividend will be generating a pretty significant dividend in their own right, which will be used to purchase more shares. And over a period of many years, that really compounds, and you'll end up with far more shares than you actually ever purchased yourself just from the dividend continuing to buy more shares. So you also want to continuously add to your position, keep buying more shares as you get more savings. And the reason for that is just because these stocks are likely to drop at some point in the near future, just because they're trading so highly right now. So the third stock I really like is Google. And I really like this stock over the long term because Google is the #1 advertising network online. A lot of people don't realize that Google is what Google is all about. And basically, Google is an advertising network online. They are the hub of advertising online. They have excellent data collection, and they have so much reach online. Google search and YouTube are in the top 3 sites on the internet. The only other one that comes close is Facebook. And in addition to those 2 services, Google also has what's called the AdSense program, and it's basically a service that any website owner like myself could sign up for to implement Google Ads on my website. And then, advertisers can bid to advertise on my website or any website. They can bid topically. So like a financial investing company might, put into Google they want to advertise on stock sites, and Google will automatically match that up and display those ads on my site. And many other stock sites out there are using this program. And this program has tremendous reach. Hundreds of thousands, if not millions of sites run AdSense. So between these 3 services, Google Search, YouTube, and AdSense, Google's got so much reach online. Nobody comes close. Facebook doesn't come close. No one delivers the kind of ad impressions that Google does. And really, all of Google's services support this ad network in some way, either directly or through data collection. And what I mean by that is, Google has that Android and Chrome. And Android is great for Google because it comes preloaded with Google Search. Everyone using Android will automatically be they'll automatically be searching through Google and seeing Google search ads that way. And then if they're downloading apps for their Android phone, they'll be getting Google's advertisements in those apps. And there's a lot of things that just do data collection. Like Google Chrome, for example, doesn't actually display Google Ads. I mean, it does have Google Search set as the default, but it also provides data for Google. It helps improve their search engine results by collecting data on websites. If Google thinks that you like a particular website, it might rank that site more highly in the search engines if it continues to notice that people like the site. And this just gives Google more information. It lets Google collect information on its users, and a lot of people don't like that sort of thing. And Google does offer different privacy options, but the point is, all this data lets Google deliver better ads that are more profitable for the company. And all this culminates in the fact that our internet advertising is steadily increasing, and it's going to continue to increase for many years. More and more advertisers are going to spend money on ads online just as more people are going online. That's just the way it is. So, a lot of companies still are behind on this. Internet advertising is still in its very beginner phases. The spending could significantly increase over time. So Google is just well positioned to benefit from this. So the final stock I really like is Amazon. And I think Amazon's set up for long-term growth like Google, just because Amazon's the #1 e-commerce retailer online. No one else even comes close. And e-commerce revenues are growing by double digits every year. So Amazon's going to benefit from those increases. And if you look at Amazon's revenue chart, it shows that. It shows double-digit revenue growth. Just because more people shop online, they're going to shop on Amazon because Amazon's got the best products at the best prices with free shipping, best customer support. They've just got the infrastructure that no one else does. And they have the brand, too. And 2 lesser-known things that people don't consider about Amazon are its digital content, which includes things like ebooks, but it's increasingly including music and movies, along with something called cloud hosting, which is a new way to host content and websites for companies. As an example, Netflix uses Amazon's cloud hosting to deliver its videos to people. They actually don't own their own servers; they rent space from Amazon. And the reason these 2 services are relevant is because they have very little cost for Amazon. They're very high margin. When Amazon sells a $10 ebook, the data transmission is virtually costless, but they take 30% of that sale, with the other 70% going to the publisher. And same thing goes for cloud hosting. I mean, they have to pay for their servers and the bandwidth, but it's really a fractional cost of what they're able to charge. And between these 2 products, ebook sales alone are in the billions. Amazon's making billions of dollars of revenue off of very high margin services, and it's using that extra revenue to help expand its e-commerce reach and grow its infrastructure. And it's just really setting them up for long-term growth. So I really like all 4 of these stocks for the long term. All 4 of them are very expensive at the moment, though, relative to what they're worth. So, you could buy now, and a year from now, they might be worth a little less, but that's okay. You want to continually add to your position to protect yourself against any drawback, and just hold these for a couple years. While they might be worth less tomorrow than they are today, they're going to be worth more in 5 years or in 10 years, assuming the tech companies are still relevant. And that's what we're really going for here. This is long-term growth stocks, and I hope that you found this video helpful. Like I said, continue to add to your position, use dividend reinvestment, stick it out. Don't worry about quarterly reports. Look at the long term here.